Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Most landlords start the same way: one property, one mortgage, one lender, one renewal date, and then another property and another. Fast forward a few years and what you've actually built isn't just a portfolio, it's a financial jigsaw puzzle. Different lenders, different rates, different expiry dates, different stress tests, and very little visibility on how everything works together. So in this episode, we're talking about portfolio loan mortgages, where instead of financing each property individually, you look at funding your portfolio more strategically, sometimes under one facility. So we'll break down what it is, who it works for, and the pros and cons of this approach, so investors can understand whether it can be right for them. So let's get into it.
Welcome back. Mark, how are things? You good?
I'm very well. Very well. Yourself?
Yeah, good. So today we've got something slightly different topic. We're going to talk about portfolio loans and the difference between those and a number of various, having a property portfolio with individual loans across it, which is the normal setup for most landlords. But I think that there's a bit of a common misconception with terms, as there are with many different terms. Terms can have a number of different meanings. So obviously one of the big ones from a mortgage space is a portfolio landlord, in inverted commas, which is a definition of the type of landlord you are based on the number of properties that you have from a PRA, Prudential Regulation Authority perspective, and how you're treated from a mortgage perspective. So that's one thing that we deal with internally from a labeling perspective. But then you also have the difference between a portfolio landlord with a number of properties and a portfolio loan over those properties. So do you want to just kind of give us a bit of detail about what a portfolio loan is, or a portfolio loan mortgage?
Yeah, sure. So we get asked this quite frequently. We deal with a lot of investors who have multiple properties, and for one reason or the other, we do get asked about these portfolio loans. I guess, I've heard things as, a mate of mine's got one, how do I get one type thing? So there's possibly a status attached to these portfolio loans, as well as we'll get into the detail as to, the pros and cons as to what this is all about. So for the purposes of this conversation, let's say a landlord's got 10 individual properties. Okay, so these aren't multi-unit blocks. These are 10 individual properties in their portfolio, currently sitting across multiple mortgages, which is, like the standard way of doing things. A portfolio loan is simply one loan secured across all of the individual securities, okay, up to X% loan to value, okay. So you've got one loan, one lender, one mortgage repayment, and multiple securities that support that loan. So that is essentially what a portfolio loan is. We'll go into the pros and cons and what you should consider when doing it. But that's the key difference. Whereas a normal portfolio is made of one property, one mortgage, two properties, two mortgages, and so on and so forth. This is one loan, multiple securities, one mortgage payment in a sense.
Okay, cool. And so can anyone get them? How does it work in terms of criteria?
Yeah. So in theory, anyone with more than one property can have one. So I guess the best way to describe it, rather than a portfolio loan, is a loan with multiple securities. Yeah. So if you think of it like that, you can, as long as you've got more than one security, in theory, you can have it. It really only starts to make sense, in my view, when you're sort of over the 10. I'd even argue more than that. Again, I think it makes more sense where the value of the loan runs into the millions rather than keeping it. It certainly doesn't make sense less than $1 million, I don't believe. But then everybody might have their own objective as to what they're trying to achieve. So we talk about, revert back to, which we always do, is, what is your goal? What is your objective? What are you trying to achieve? And is this the best way of doing it? So yeah, that's where I sit. But no conversation I have had to date makes sense. Certainly where the value of the portfolio is between 1 million and 2 million. That's for sure.
Yeah, I'm guessing with your business banking background, commercial banking background, you've probably seen more of these than what I will have. But in my, however many years, I've lost track now, 16, 17 years of advising, I've probably only seen a handful of them, maybe 10, 15 max, I think, over that time frame. So they are pretty uncommon in the main, which probably just goes to show why, whilst people ask about them, the reality of them actually getting one is probably less. Now, there's probably a reason for that, and which we'll cover off the pros and cons, like you said, shortly. But ultimately, these are generally for portfolio landlords, so those with 4 or more properties. The majority of the ones that I've seen have been in limited companies rather than personally held as well, which is probably a key differentiator. And just landlords who are running things like more business-like, for want of a better word, generally experienced, generally bigger in nature, and yeah, sometimes also a mix of residential, maybe some semi-commercial properties in there as well, which might be the reason why they've gone down that route also. So, and then probably, who it's not for is, first time landlords, simple, small portfolios, vanilla lending, because obviously if you can get, generally speaking, the rates are higher than what you would get from your vanilla lenders. And when we say vanilla, that's probably a term that's used quite frequently in our industry. So, a simple family let, property, 200 grand, single buy to let, let by a family, the TMWs, the BM Solutions of the world, high street lenders, cheapest rates you can get, you're not going to go away from that. So if you've got a small portfolio of those, there's no real point in doing it. So let's talk about more of the detail of the pros maybe then first, and why an investor would potentially be attracted to looking at this.
Yeah, so I mean, a big one is going to be convenience. So one relationship, one point of contact, one relationship, one mortgage payment. So from an administration perspective, once it's been set up, I'm separating the setup of the facility to the ongoing management of the facility. So the setup is going to be more involved, clearly, because of all the legal aspects to it. But the ongoing is going to be one relationship. You've got one mortgage payment, so the administration work of it is going to be pretty light in terms of that. It's going to be really easy to stay on top of from that perspective. One price, so it's really easy to forecast what your pricing is going to look like going forward. Depending on what your rate looks like, will be driven by how it's made up. What I mean by that is it a percentage over over base rate? Is it a percentage over SONIA? Is it a fixed rate? All of those sorts of things means that world events, as we've seen, which influence interest rates, are a little easier to understand with the impact of that on your whole portfolio. Whereas on an individual basis, you don't necessarily understand the impact per lender, which is often the case in those as well. And I think the other thing would be, and this has been my experience of them in the past, is by having one relationship, you've got the lender's got a very clear line of sight as to your whole set of circumstances. Now, this can be a pro and a con, but we'll keep it as a pro for now. It should be easier when you've got that relationship to just extend that facility if you want to go and buy something else, and so on and so forth. They've already underwritten you to this extent. Adding to your portfolio means they already know you as an individual. They're literally just going to be assessing the property and does it make sense and does it fit into the portfolio with the loan to values that have been arranged and so on and so forth. So those really for me are the real pros to it. I think people find it attractive because there is this perception that once you're in that lender, going to extend your portfolio is a lot easier, and it can be. But as I said, there's a negative to that conversation as well.
Yeah, definitely. And I think, having, I think this probably goes back to some old school banking, which we see in less and less of. A lot of lenders, you sort of banks generally just don't have less and less bank managers, don't they? And there's a lot less done face to face and what have you. So they aren't, this is kind of the lenders that will offer this facility. Their pitch or USP is, relationship-based lending, old school banking, having a point of contact that, you can pick up the phone with, have a meeting with, and which, as you said, can be a pro and a con. But they know your business. They should know your business inside out. They understand what your strategy is and allowing you to go and get potentially opportunities better than with less friction if your portfolio allows.
Yeah, and there's a saying which I like actually, and this is where the portfolio loan sort of plays into is, if you owe the bank £1 million and something goes wrong, you've got a problem. You've got £1 million problem. You owe the bank 15 million and something goes wrong, they've got a problem. Yeah, so the bigger that number is, the shift of the relationship and the power moves across to you as the borrower. So if you've got a substantial portfolio and a substantial loan, which runs into the possibly tens of millions, then they're clearly incentivized to make sure things are going well for you. When you're smaller, and you're a smaller fish in quite a large pond, that you don't necessarily have that level of influence. So portfolio loans can get you into that sphere really, whereby you do have different balance of power in that relationship. Whereas if you do that on individual mortgages, you're never going to get to that because you're only ever going to go per unit X, a couple 100,000 maybe or something like that.
Yeah, I think we touch on the cons now shortly. Is one of the big ones for me around that risk. What you just mentioned there is the 1 million. If you owe the bank $1 million, it seems like a lot of money, but to a bank, it's not. And probably one of the biggest cons is around that flexibility. I think it was slightly before my time in this market, but I have spoken to a number of investors who were around during the 2006, 2008, that period in the credit crunch, and they banked with RBS. And for those old enough to recall, RBS basically just pulled a lot of people's overdraft facilities. So they shut down businesses overnight and then reclaimed their assets because if the business had a trading location or some assets within the business and then they ended up repossessing them and closing the business down and things. So it's a kind of similar thing with this, where you are at the mercy of a single bank. And if something goes wrong with that bank or the market changes, they can call in that loan because it's a commercial loan rather than more of a long-term residential type loan, where they review this on a periodic basis, usually 12 months, but sometimes 5 years, to make sure that the loan to value still stack, that the rent cover interest still stacks and everything else. And so if they've lent to you at 70% loan to value and the market drops by 25%, they'll turn around and say, well, actually now we've revalued your portfolio. It doesn't meet the 70% anymore. You need to bring the balance of those loans down to 70% of the current value, which, if your portfolio is dropped by 25%, that would only happen in a downturn or in a serious crash. Where are you going to find the money from during that crash to bring down the balance on those loans? And so then you could be taken to a fire sale scenario to pay them back, and you've left with very little flexibility and liquidity in terms of what you can do in terms of your options. So that for me is probably the biggest risk in all of this.
Yeah, and look, credit risk or having that one relationship is a huge risk. I think that's, whilst people look at costs and all of that sort of stuff, that for me is the number one risk. Like if you take, for example, Handelsbanken, old school bank, like to do things the old way. The systems probably echo that. I don't know what they've been like recently, but they were certainly like that for some time. But I would say 10 years ago, they were the place to go for property. They had a balance sheet, which basically anybody who was serious in property would just go knock on Handelsbanken door, and they would be the lender to speak to. invariably they did so much property, their balance sheet was so full of property, they had to stop doing property. So if you were a portfolio landlord who had a great relationship with Handelsbank, that came to an end at some point because the appetite dried up, you can't keep doing the same thing, because as a lender, if all of their lending is in one segment, that's poor risk management from a bank's perspective. So you can only go so far if you're not doing the trading stuff to offset, the segments and the risk profile of the balance sheet and so on. So what would happen there is literally you would be in there, you would have a great relationship with them, probably 10, 15 properties in, whatever it is, and then you realize the appetite's no longer there. And you've now got to go and find an alternative lender where all of your things are in a row. Coming back to, I'm probably jumping a bit ahead, but coming back to the facility letter that you'll get. So you won't get a mortgage offer as such, okay? And this is where it differs significantly from a mortgage, the usual sense. So when you get a buy-to-let mortgage, you get a mortgage for the term, which is 10, 15, 25, 30 years, whatever you decide. The commitment of that money is for the full life. So it's a life commitment of the monies. And that's it. You don't have to do anything else. As long as you're making the repayments, the only other choices you have is when your rate changes, you've got a choice to stick with the same lender and do a PT, a product transfer, or you change lenders. But if you do nothing else, there's no other obligation on you other than to stay in line with the mortgage offer terms, which is keep running as a buy-to-let, et cetera, et cetera. And as long as you're keeping the payments, they're happy as.
And examples of these would be your likes of your mortgage expresses, your assigners now. There's landlords with plenty of these options out there who had lifetime trackers attached to some of their deals from pre-2005, and they've just sat on those. The back book's been sold, but they don't have to, the bank can't call in that loan, because as long as you're making your payment and you're meeting the conditions, they can't call in the loan. And so they can send you sort of letters and ask you to pay it off, but they can't force you to, is the difference, isn't it?
Yeah, and what you'll have with a portfolio loan, rather than a mortgage offer, you'll have a facility letter. Now, a facility letter, for those that are not familiar with the term, is more of a commercial structure loan, okay? And it looks and reads quite different to a standard mortgage offer. So what you'll have in there will be very often a term commitment. So we'll call it, so it's a repayment profile. So they'll often say, what's the amortization profile of the loan, i.e. how long you're going to take to pay it off. So let's say 25 years, you'll have a repayment profile of 25 years. However, the lender might only commit to giving you the money for 5 years, which means at 5 years, there's effectively a break clause, for want of a better word, whereby it's up to them where they reassess the loan and decide whether they want to continue to give you the money or whether you have to repay it and then go find an alternative. So very common, this 5-year term commitment of monies. There's a reason why they do it due to balance sheets and whatever, but we won't go into that. So that is a fundamental shift. You're no longer 25 years of money now, you're 5 years of money. The other thing that you'll find in there will be something called revaluation clauses. Okay, so at any point, as you said earlier, they can come back. I say at any point, it's usually stipulated when they can do it in the facility letter, but it will be written in there. They can ask you to go and revalue the portfolio at your cost. Yeah, so you've got 200 houses, you've got to pay for 200 valuations, basically. So it's at your cost again to re-evidence back to the lender, because that's what you're doing. You're proving to the lender that they're worth what you said they were worth still. And as you say, if it isn't, or if there's, they've gone down in value and it breaches the loan to value covenant, because you have covenants in these letters as opposed to conditions type thing, it breaches the 75% or the 70%, whatever has been agreed, you have to reduce the loan by that percentage. If you don't, or if you can't, then you'll go into something called forbearance. Forbearance is basically you're in breach of your loan, but we reserve the right to action, to take action to recover, but we're not going to. So we write to you to say we reserve our rights. It's going to sit here in a default position, but we're not going to act upon it from that perspective. And they may put you on a different interest rate because you're now in breach of the loan. So you might go into default interest in that sense. And then you'll have other loan covenants to satisfy, which will be, and you mentioned this again, is on an annual basis, they'll test the loan covenants. Now, those loan covenants could be they've agreed the rent versus mortgage payments need to have a certain gap between them, the debt service coverage ratio. They'll test that per annum. So if if you have more voids than you had previous for whatever reason in that given time of testing, you could breach the loan covenant, can go into a forbearance position if you can't get it back to recover, and so on. They may, if this is something that was quite common that we used to use in HSBC, was a total net worth, TNW covenant. What that meant was the balance sheet or the shareholder funds, the value of the company couldn't fall below a certain figure. What that usually meant, the reason we did that is to stop directors from drawing too much money out of the company and then devaluing the asset, it all the time. So these are all the mechanics of this loan become quite different, and the expectation of you as the borrower become very different in this space. So you can see now how all of a sudden it's great. I've got this X million pound loan covering it. All of it is convenient, but you have to do things every year. You have to stay in touch with the lender because they have so much control effectively. And what looks like really attractive in the beginning, if you don't fully understand what you're getting into, then you could find yourself in quite a difficult relationship going forward. And obviously any difficult relationship that involves that much money, it's like any divorce, isn't it? It's going to cost you a lot of money to then go and find a new lender anyway. So you might as well not
doesn't end well.
Yeah.
The other thing that which is a big point to think about, is if you have a portfolio and you want to, for whatever reason, free up some cash, and you might, I don't know, your daughter might be getting married and you just think, God, I'll just sell one of my properties and free up some money to pay for the wedding or whatever. You need to check again the covenants to see, if you sell a property for 100,000 and you've got a 70% loan, you would reduce the loan by 70%, and then you would get, if you had a single mortgage on it, you'd get the remainder after the sale proceeds, etc. Am I right in thinking that flexibility isn't necessarily there with individual sales on these types of loans?
Yeah, so you can sell what you like in effect, but they will look to keep 100% of the sales proceeds. So to keep the numbers nice and simple, let's say it's 100,000, 75,000, 75% loan to value. Under normal circumstances, you sell that £100,000 property, you get the 25,000. The lender will retain 100% of the proceeds of that to reduce the loan. So the loan won't necessarily reduce in line with the loan to value that was originally agreed. You have to negotiate with the lender that they will actually allow you to keep it. And again, in my experience, every single one of them says, yes, we'll do that. You have to ask for a consent, but there's no reason why we shouldn't allow you to do it. And in reality, it's a far more difficult conversation to be had because they've got other mechanics that sit in the background. Bear in mind, they are looking, so you're looking at your portfolio and your loan across your portfolio, yeah? They are looking at their portfolio and they are lending across their portfolio. If somebody else has done something and it's gone and the whole LTV is out of position on their portfolio, then they might not necessarily consent to you having the LTV because they need to get you down to 65% to offset somebody else who's gone into breach and is now at 85%, for argument's sake. So it's not as vanilla or as straightforward as going, yeah, we'll just give you the 25% back, because there is a bigger conversation going on in the background that they need to balance their books.
Yeah, absolutely. So within that, you said, whilst they'll say all the right things to say, yeah, the reality is you don't know what that is. And if they've got the option to withhold it, then they've got the option to withhold it, in which case you don't have that flexibility. So I think the benefits, just kind of recapping some of these pros and cons and pitching them off against each other, there's one of the big benefits is a reduced admin headache in terms of, from a mortgage perspective, let's say you've got 30 properties, that's 30 mortgage renewal dates. You'd always be in a constant remortgage process, almost, depending on where you are in a 2-year, 3-year, 5-year cycle. You probably always feel like you're doing mortgage paperwork. So that's an admin piece. keeping an eye on those dates. Obviously, we've mentioned before, we've got some software that can help you with that, with PinTech. Cheeky plug there. So if you haven't checked it out, check it out. Pintech.io, but helps landlords manage their portfolio. But ultimately, having that constant headache taken away, that's a big plus. But you are paying for that because, so whilst it's one mortgage payment, one loan, generally speaking, the rate is a commercial rate rather than a vanilla buy-to-let rate. Now, if your property portfolio is made up of 30 single buy-to-let properties, this may not be as attractive for you because of the difference between the rate that you would get on those vanilla properties versus the rate that you would get on the portfolio loan is unlikely to be that similar. To you've got to just weigh up the headache versus the cost, the more expensive cost. However, if you have a portfolio of 30 HMOs of probably 6 beds or more, multi-unit blocks, commercial properties, etc., then this may make sense because the rates are not going, it's in the specialist space. They may not be too far away in terms of what the rate looks like, in which case you're saving the admin headache. So, it's weighing up these different risks against each other and deciding what's best for you and your portfolio and the way you run it effectively, isn't it?
Yeah, and I've obviously explained some of the negative sides to it. Like I say, at this level, I don't see that it works particularly well. There's too many cons in it versus the pros. However, if you've got a substantial portfolio, where I see this probably making more sense is if you don't look at it as a property in isolation, whereby somebody's got a large portfolio. Now, thinking of that individual, they probably got other interests. These are private banks usually that will get involved in this level of stuff. Your Coots of the world, all of those sorts of lenders. You're going to be ultra high net worth, most likely. If you've got that level, if you're in the tens of millions, you're a high net worth individual. You've probably got other interests. You have other demands on your personal life and personal interests and what have you. And they probably come with not just the portfolio lending, but they come with a full package of the private banking, the relationship manager, and everything else that comes with it. And it's a suite of solutions as opposed to just having a portfolio loan. You may have I suspect somebody with that level of portfolio will have their SAS interests, their pensions will be brought into the equation, and it becomes quite sophisticated in what it is. That, for me, then makes absolute sense why you would go through the trouble of setting up this type of facility, because it links into the bigger picture. On a standalone basis, just because I've got 20 properties, doesn't really make a great deal of sense to me. I've never seen it work logistically on paper. The other thing, just to jump in on there as well, is the other reason I don't see this happen very often is the logistics of getting your portfolio out of all of its mortgages and into one loan. You've usually got, for interest rates that are maturing over different points, you need them all to be on a variable rate so that you don't incur all the ERCs, early repayment charges, or you have to pay all the early repayment charges to come out of that loan to go into a different loan that's probably more expensive, and so on. So, as I say, whenever I've looked at this, the cost of doing it outweighs, the payback time is years sometimes because of all the intricacies and the logistics of actually getting out of where you are into that one loan fits all. So there's a lot of things to consider on these portfolio loans.
Yeah, absolutely. So for me, it's probably like not having all your eggs in one basket. That old saying is, if you've got a portfolio of 50 properties and you've got them all with one lender, you are at risk. The market takes a tumble. Like we said, example with RBS in the past, even if you split that over 5, you had 5 with Santander and 5 with TMW and 5, because you got to remember that, you've got Lloyd's Banking Group, which is made up of a number of different brands within it. And so you always need to take that from a brand perspective. It's the same as, one savings bank covers off Precise, what was Kent Reliance is now Rely and Interbay. within the specialist space. So there's pockets of these, and you would probably want to, if you're going to share the load out, you're probably going to share them outside of different banking groups as well to spread that risk so that you're not just overexposed within that.
Yeah, and we've seen the best banks fall into trouble historically. And I know there's Basel III, which is, enhanced capital adequacy. However, we are seeing in the political system at the minute whereby, there is a push to relax regulations on banks to encourage more lending to businesses and so on and so forth. This type of lending falls into a different capital adequacy rule to that of a buy-to-let mortgage, which means, so for example, I think it's 14% is the figure. So for every £100 they lend, they need to hold £14 back as, default monies in a sense. If my memory serves me right, with this type of lending, because it's more commercial and facility letters and what have you, the capital adequacy requirements are less. So that banks are obviously incentivized to do more because they can get more out with having capital reserves and so on. And you're just not in control of what the bank decides to do. We've seen it happen in the past. Look, it's unlikely to happen. I'm not saying we're going to go through another thing, but there's a lot going on in the world, a global recession and all these sorts of things. And some of the forwards and the shorts and the derivatives and whatever not doing what they do, and it could push banks into difficult positions. If you're caught up in that, it could be extreme. It could break you.
Yeah. Cool. Well, look, I think we've covered that off well enough for people to kind of understand what it is, how the structure may or may not help them, whether it would save them more headaches and hassle, and whether that cost is worthwhile. So if anyone that does have a portfolio want to discuss it, then obviously get in touch. But, it's just asking yourself, the strategic question: what are you trying to achieve? What's the best structure for your portfolio, and what does good look like? So think about your concentration risk, your long-term strategy, what is your current debt across your portfolio, and then just kind of deciding whether you want more flexibility or less. And just understanding the overall dynamics of your portfolio will, as we say, you should be looking at your portfolio. We think that a lot of investors don't actually sit down and look at their portfolio and think and ask strategic questions that often, which you should be doing at least once a year. We probably should be doing it more than that. But that should be, those decisions should be driven by data as well, not just whimsical decisions based on guts and things. So, having all, I joked earlier about the plug for PinTech, having all of your data in one place and up to date and being able to stress test different scenarios does make a much easier decision when it comes to strategic decisions.
Yeah, definitely. As I say, start with the end in mind, all of that good stuff, I think. But, it's not to rubbish the portfolio alone. I just am yet to see legitimately and genuinely a strong argument for when you take everything into consideration. Clearly, there aren't scenarios where it works. Otherwise, this wouldn't be a thing. It's just I'm yet to come across that many of them.
Yeah, awesome. All right. Well, listen, as always, Mark, thanks for your time. And we'll see you on the next episode.
Yeah, fantastic. Thank you very much. Okay, so there we have it. Hopefully you found that really useful. Plenty to pick apart in there. So just to sum up, portfolio lending can be incredibly powerful when it's used for the right reasons. It's not about making finance more complicated, it's about making growth more sustainable. For some investors, one loan across multiple assets creates clarity, flexibility, and scale, whilst for others, it creates unnecessary concentration and restriction. So the key here is understanding the structure before you commit, because in portfolio lending, strategy matters far more than just an interest rate. Thanks for listening, and we'll see you on the next episode.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.